What happened didn't look like a crash. It looked like an evacuation. In the space of just 72 hours, BlackRock quietly liquidated £14 billion worth of UK residential property. £14 billion. Gone. No gradual rebalancing. No orderly exit. This was a full-scale dump executed at losses approaching 40%. The world's largest asset manager didn't blink. They took the hit and ran. That alone should have been headline news. But that wasn't what broke the system. The real rupture happened at 11:47 p.m. on Tuesday night, when internal Bank of England stress test results leaked to financial terminals. The numbers were catastrophic. According to the bank's own modeling, a 20% fall in house prices would require UK banks to raise £230 billion in emergency capital to remain solvent. House prices have already fallen 12% in real terms. That means the system is only 8 percentage points away from failure. At the current rate of decline, analysts inside the system estimate that UK banks are roughly 17 weeks from insolvency. And yet, almost no one is talking about it publicly. The 4 days that changed everything. Between November 18th and November 21st, something unprecedented occurred in the UK property market. This was not a slow downturn or cyclical correction. It was a stampede. It began with an emergency board meeting at BlackRock on Sunday night. By Monday morning, sell orders flooded the market. Not listings, liquidations. £14 billion of property dumped at whatever price the market would accept. Vanguard followed. Tuesday, £8 billion exited. State Street followed on Wednesday, £6 billion more. By Thursday's close, £43 billion of institutional property investment had fled the UK in just 4 days. These are not emotional investors. They are driven by algorithms, quantitative risk models, and stress test triggers. When they all move at once, it means every model reached the same conclusion at the same time. UK property had become toxic. The trigger nobody was supposed to notice. What set this off wasn't a speech, a rate hike, or a headline. It was a single data point buried deep. Page 847 of the Office for Budget Responsibility's autumn forecast. Projected UK mortgage default rate by March 2025, 11%. For context, the 2008 global financial crisis peaked at roughly 3%. When institutional models saw 11%, they didn't debate it. They didn't hedge. They ran. Then came the leak. The bank stress test that ended the illusion. At 11:47 p.m. Tuesday night, someone inside the Bank of England leaked the full stress test results. What they showed effectively ended UK property as a viable investment class. Under a 20% house price decline scenario, Lloyds requires £43 billion in immediate capital. Barclays, £38 billion. NatWest, £29 billion. Santander UK, £26 billion. HSBC UK, £34 billion. Total, £230 billion. Money the banks simply do not have. The Bank of England holds roughly £90 billion in emergency reserves. That covers less than 40% of the shortfall. The rest can only come from one place: depositors, pensions, and state intervention. This is why mortgage lending has quietly frozen. Mortgage approvals have collapsed by an estimated 87% month on month. Banks are hoarding liquidity. They know what's coming. The March 31st cliff edge nobody is prepared for. Most people are focused on interest rates. That's the wrong variable. The real detonation point is March 31st, 2025, when roughly 2 million Help to Buy equity loans hit their 5-year mark. Interest jumps from 0 to 1.75%, then rises annually. Millions of households suddenly face hundreds of pounds a month in new costs they never budgeted for. And here's the trap: these aren't conventional loans. The government owns a percentage of the property, not a fixed amount. If your £400,000 home falls to £300,000, the government still owns 20%. You can't remortgage due to negative equity. You can't sell without owing money. You can't stay because you can't afford the payments. That's 2 million trapped households, all hitting distress simultaneously. Pensions, gating, and legalized denial. UK pension funds hold an estimated 62% exposure to UK property. Last week, Legal & General gated its property fund. Then Aviva. Then M&G, roughly £43 billion in pension property funds, are now locked. No withdrawals. Why? Because the assets cannot be sold at their stated values. Mark them to market, and the funds are insolvent. The Pension Protection Fund modeled the fallout. At a 20% price decline, 412 UK pension schemes fail, impacting 12 million people. The government's response? Quietly amend pension funding regulations, reducing required funding levels from 90% to 70%. In plain terms, insolvency was legalized. Foreign capital didn't leave gradually. It vanished. On November 19th, Beijing announced new capital controls. Chinese citizens owning foreign property must repatriate proceeds or face prosecution. No exceptions. Roughly 600,000 Chinese-owned UK properties, valued at £800 billion, were suddenly forced onto the market. Luxury areas were hit first. Mayfair, Kensington, Westminster. Properties listed at 40 to 50% discounts, cash only, 7-day completion. These weren't negotiations. They were liquidations. Singapore followed, then Middle Eastern funds. In under a week, an estimated £1.6 trillion in foreign property capital turned seller. That's roughly 60% of total UK property value. Why prices collapsed before humans realized. Property prices are no longer set by people. They are set by algorithms. Rightmove processes 18 million searches a day. Zoopla tracks behavioral data that reveals real affordability long before buyers articulate it. By late October, the data showed a structural shift. Smaller homes, more rentals, searches outside the UK. The machines calculated the breaking point. When average property prices exceed 12 times average income, transactions stop. The UK hit 12.4. On November 15th, the algorithms effectively declared the market unviable. Humans just hadn't caught up yet. A silent bank run in the end of ownership. This isn't a visible bank run. There are no queues. It's digital. Withdrawal requests are reportedly up over 400%. Funds are moving offshore, into euros, dollars, gold, crypto, anything but sterling deposits. Banks are meeting withdrawals for now, with covert Bank of England overnight lending, over £100 billion last week alone. When banks rely on emergency liquidity to meet withdrawals, they are already insolvent. They just haven't said so. Withdrawal delays, technical issues, enhanced checks, these are undeclared capital controls. Your money is no longer yours by default. It's yours by permission. Councils, insurance, and the final lock. UK councils are collapsing. Property-dependent tax revenues are evaporating while debt remains. The government has told councils bluntly there will be no bailouts. At the same time, insurers are exiting. Zurich, AXA, Allianz. Nearly 40% of UK property insurance capacity vanished overnight following updated flood risk models. No insurance means no mortgage. No mortgage means no buyer. No buyer means no value. Millions of properties have effectively become unsellable. The endgame. The government knows all of this. Internal Treasury figures reportedly show debt to GP near 130%, unfunded liabilities of £4 trillion, and property-linked exposure approaching £14 trillion, over 6 times UK GDP. When property falls 30%, the state itself becomes technically insolvent. So the strategy is not prevention. It's management, emergency powers, capital controls, regulatory changes, and narrative control. This isn't a gradual decline. It's a staged collapse. The smart money already left. That's why BlackRock ran. That's why insurers quit. That's why banks stopped lending. The UK didn't just financialize housing. It built its entire economic identity on it. Now the paper wealth is burning. The UK property market didn't crash overnight. It died overnight. We're just watching the body.